In this video, we introduce the broad field of economics known as macroeconomics. We have previously defined what economics as a discipline is all about, revolving around the concept of scarcity. We concluded by establishing the inevitable need to ration scarce resources in a world of unlimited ones. In broad terms, economics can be divided into microeconomics and macroeconomics. Macroeconomics is defined as the study of aggregate behavior of the economy. It takes into account all the factors within the economy. The best way to illustrate this is by comparing it to microeconomics, which studies the behavior of individual economic agents, being individuals, households, or firms within the economy. Macroeconomics, on the other hand, takes into consideration the aggregate behavior of all the individual agents within the economy, and this can be at country, region, or global level. Thus, modern macroeconomics is built on the foundations of microeconomic theory. Macroeconomists give empirical content to the theory by collecting and analyzing actual data. The data is used to test whether a proposed theoretical relationship is valid, to measure quantitatively a relationship, or to explain the past history of an economy, or to support some predictions about some future course of the economy. Some of the important topics that we'll be exploring under macroeconomics include gross domestic product, GDP for short, unemployment, inflation, interest rates, investments, consumption, government expenditure, and balance of payment, amongst others. The famous income identity summarizes these key concepts in macroeconomics. And the identity is given as follows, where GDP is equated to consumption, investment, government expenditure, and the difference between exports and imports. GDP is the total monetary or money market value of all the finished goods and services produced within a country's borders in specific time period. Unemployment, on the other hand, is measured by dividing the number of people actively looking for jobs and cannot find them by the entire labor force of the country. Inflation, on the other hand, is the continuous increase in prices of goods and services, which can simply be defined as a fall in the purchasing power of money in your pocket. The balance of payments is the difference between payments made into and out of the country over a certain period of time. All these concepts we're talking about are part of macroeconomics, which can be handled at different levels of studies. But in our case here, we will be assuming the entry to intermediate levels at undergraduate. We will be covering each of these concepts in greater detail in subsequent videos. I hope with this short expose, you have a rough idea of what this broad field of economics called macroeconomics is all about, and you have an idea of what to anticipate in terms of the content that will be coming on the specific components of macroeconomics. It's going to be exciting.